Thank you, Chairman McHenry, and thanks to Ranking Member Waters, and thank you to our august guest for being with us today. Acting Comptroller Sue, last year, Senator Elizabeth Warren sent you a letter urging you to block the TD Bank First Horizon deal. And reports suggest the deal fell apart 2 weeks ago because the two banks were not given a timetable for regulatory approvals. First Horizon stock is down 50% since the failed merger with TD Bank. As I'm sure you are aware, markets can handle good news, markets can handle bad news, but what markets can't handle is inconsistency. So, Acting Director Sue, what impact did Senator Warren's letter have on your decision to slow walk this merger?
Thank you for the question. So, on every merger application, we follow the law, we follow our guidelines, we follow our policies and procedures. And by the law, we've got the Bank Merger Act. There are a list of statutory factors that a merger must, we have to consider the impacts on competition, on the convenience needs of the community, on financial stability, on the financial and managerial resources of the entity, on BSA/AML compliance. We have to take all those into account for statutory purposes. Under our guidelines, the Comptroller's Licensing Handbook, which is public, we list out the standards by which we apply, the framework we apply to evaluate those, and we do that in every single case.
So I'm wondering, you testified that the OCC is committed to being open-minded when considering merger proposals and to acting in a timely manner on applications. What about the OCC's actions during the TD Bank First Horizon merger was timely?
So every case is different. We do everything, we have to evaluate each case on its merits, and we do so applying those standards equally. But as I said, I can't speak to individual transactions. What I can say is different transactions have different features. Some of them can be dealt with more quickly than others.
So how long should banks expect for the OCC to typically approve a merger? Is it 6 months? Is it 12 months? Is it 24 months? U.S. Bank and Union Bank and Bank of Montreal and Bank of the West each waited over a year for their mergers to be approved, and TD Bank and First Horizon waited over a year without an answer. So I'm wondering, there's an old saying in the law, justice delayed is justice denied. Do you have enough staff at the OCC to review these things in a timely manner?
We do have enough staff. The closer that a merger hews to the statutory factors I just listed out, the faster that approval will go. I think this does highlight that the frameworks that we use to apply the statutory factors are old. They've been around since 1995. We have been working across the agencies, not just the OCC, but with the Fed, the FDIC, and with the DOJ to try to upgrade those, update those to current times. That's a project we're working on because we want to make sure that that's updated and modernized for today's environment.
I must say I'm skeptical about the timeline, and I wonder, how do you balance the need to promote competition in the banking industry with the need to allow banks to grow and innovate?
So again, we take each case on its own merits. We evaluate those against the statutory factors and against our guidelines. It's hard to generalize because each one of these cases is a little bit different.
Chairman Grunberg, as part of the deal to acquire First Republic, the FDIC had provided J.P. Morgan with a $50 billion note. I know you're familiar with that. What was the interest rate agreed to on that note?
I think it was 3% I'd have to double check on that, Congressman.
So is that the going market rate for a loan of that size?
I believe it was the market rate, but I cannot double check on that for you as well.
Do you believe that the financing at this rate satisfies the FDIC's obligation to resolve banks in a way that is least costly to the Deposit Insurance Fund?
In this case, yes, Congressman. We had a number of bids. The bids from J.P. Morgan was the least cost, and these were the terms we were able to negotiate.
Vice Chair Barr, in your view, would the interest rate risk that led to large mark-to-market losses on SVB's assets have occurred without high inflation in the United States that the United States has experienced since April of 2021 and the rapid rate increases engineered by the Federal Reserve to address runaway inflation?
the interest rate risk that it faced in the particular moment was related to the rapidly rising rates, yes.
Thank you.
Gentleman's time has
Yield back.
expired.